In today's competitive business landscape, companies are constantly seeking innovative ways to attract and retain top talent. Two popular methods that have gained significant traction are stock grants and stock options. But what exactly are these compensation tools, and how do they differ? Stock grants and stock options are both forms of equity compensation that companies use to reward and motivate their employees. While they share the common goal of aligning employee interests with company growth, they operate quite differently. Stock grants involve immediate ownership of company shares, often subject to a vesting period. This means employees receive actual stock in the company, which they can keep even if the share price declines. On the other hand, stock options provide employees with the right to purchase company shares at a predetermined price in the future. This gives employees the potential to profit if the stock price rises above the set purchase price. One of the key differences between these two compensation methods lies in their tax implications. Stock grants are typically taxed as regular income when they vest, unless an employee opts for an 83B election to be taxed at the grant date. Stock options, however, are generally taxed when exercised, with the difference between the exercise price and market price treated as taxable income. Both stock grants and options come with their own set of advantages and challenges. Stock grants offer guaranteed value and simplified accounting for companies, making them an effective retention tool. However, they can lead to immediate taxation for employees and potential dilution for existing shareholders. Stock options, while cost-effective for employers and offering high upside potential for employees, come with the risk of expiring worthless if the stock price doesn't exceed the exercise price. They also involve more complex taxation rules, especially when it comes to exercising options and selling shares. Companies often use a combination of stock grants and options to create balanced compensation packages. This strategy encourages long-term commitment from employees, while also rewarding performance and mitigating risk. By offering a mix of equity compensation, employers can tailor packages based on an employee's seniority, contribution, and role within the company. It's important to note that there are different types of stock options, each with its own tax treatment. Non-qualified stock options, or NSOs, are taxed as regular income on the difference between the exercise price and market price at exercise. Incentive stock options, or ISOs, offer more favorable tax treatment but come with specific holding period requirements. When it comes to selling shares acquired through stock grants or options, the timing can significantly impact the tax consequences. Holding shares for more than a year after vesting or exercising can result in more favorable long-term capital gains tax rates. In conclusion, both stock grants and stock options serve as powerful tools for companies to align employee interests with corporate success. While stock grants offer immediate ownership and guaranteed value, stock options provide the potential for significant gains tied to company performance. Understanding the nuances of these compensation methods, including their tax implications and risk profiles, is crucial for both employers and employees in today's dynamic business environment.